If you look at the headlines for 2025 and 2026, the US economy looks invincible. GDP is growing, unemployment is relatively low. The stock market, it's hitting record highs. But if you ask the average person how they feel, the story is completely different. Consumer confidence is low. People feel squeezed. We call this a Vibesession, where the data says boom, but the vibe says bust. So who's right? The data or the vibes? The answer is both. We aren't in a recovery, we aren't in a recession. We're in a great bifurcation. It's called a K-shaped economy. You might remember this term from another one of my videos during COVID-19. But what's happening right now from 2024 to 2026 is actually structurally different, and in many ways more dangerous than what we saw in 2020. I'm Jeff Gallick, a professor at Carnegie Mellon University's Business School, and today we're going to break down exactly who is on the top of the K, who is on the bottom, and why this split is rewriting the rules of our economy. And if you find this type of breakdown interesting, please consider subscribing and hitting that like button, as it really helps the channel and lets me create more content to keep you up to date on what's happening in our ever-complex world. So let's start with the winners, the upper arm of the K. If you're in the top 20% of income earners, the last 2 years haven't just been good, they've been fantastic. But why? It comes down to 2 letters, AI, and 2 words, asset appreciation. We are seeing a massive decoupling of the stock market from the real economy. By 2026, the top 1% of households hold about $55 trillion in wealth. That is roughly equal to the wealth of the bottom 90% combined. This wealth is being driven by the AI hegemony. The Magnificent 7 tech giants saw earnings grow by about 18% in 2025, while the rest of the S&P 500 struggled to hit 10%. But aside from the stock market, the really interesting part has to do with how the Federal Reserve is reacting to this economic environment. The Fed is largely holding interest rates steady through 2025. This tends to slow everyone down. That's the idea behind raising rates, to slow down inflation. But this time, it actually sped parts of the economy up and helped the wealthy. It's what we call a perverse stimulus. Wealthy households locked in 3% mortgages back in 2020 or 2021, so their housing costs are low and fixed. But they also have cash sitting in money market accounts earning somewhere between 3 and 5% interest, a relatively high historical rate. And even more so, higher rates mean that the stock market tends to do better because, well, it has to justify the risk of owning stocks. So higher rates actually gave the rich more disposable income. They aren't paying new high mortgage rates like the rest of us might be, but they're benefiting from higher yields on their investments. That's why luxury travel and high-end dining are booming, all while food pantries are seeing record demand. Those in the top of the K, it seems, are immune to the Fed's gravity. Now let's look at the other arm of the K, the bottom 60%. This is where the story gets darker. Remember all those excess savings after the pandemic stimulus checks? Gone. For the bottom 20%, that money ran out in early 2024. For the middle class, it was gone by 2025. Without that cushion, people are running on fumes. And by fumes, I mean credit cards. Look at this chart. By late 2025, credit card delinquency in low-income areas hit 20.1%. That is actually higher than it was during the 2008 Great Financial Crisis. We see this in consumer behavior, specifically the trade-down phenomenon. People aren't buying more stuff, they're buying cheaper stuff. It's a survival mechanism. You buy the store brand instead of the name brand, not because you want to, but because the price of everything has reset permanently higher. Now, I've mentioned earlier that we've seen a K-shape before during COVID, but I want to highlight how this K is different. Difference number 1, the cause. In 2020, the K was caused by a biological shutdown. If you could work from home, you won. If you had to be there in person, you lost. It was sudden, and the government threw trillions of dollars in stimulus at it to bridge the gap. Today, the K is caused by the cost of capital and technology. There is no stimulus coming to save the day. In fact, the government is actively tightening policy to fight inflation. This often in turn fuels unemployment, and the cycle for the bottom of the K repeats itself over and over and over again. Difference number 2, the housing trap. During COVID, everyone was rushing to buy houses. Today, the housing market is a walled garden. We have an incumbent advantage. If you own a home, you're mostly safe. You've likely locked in a reasonably low interest rate mortgage for the next 20 to 30 years, and you can ride out any increases in lending costs since they don't really affect you. But if you're a first-time buyer, costs are so high that you're facing a median age of 40 years to buy your first house. The ladder to the middle class has been pulled up. So while the COVID K was about safety, the 2026 K is about solvency. It has mutated from a temporary anomaly into a permanent feature of this economy. And this isn't just hitting families, it's hitting businesses too. On the top, we have hyperscaler companies investing $400 billion a year into AI. They have nearly unlimited cash and are using AI to lower costs and boost productivity. On the bottom, we have small and medium businesses, your local shops, restaurants, and small manufacturers. They rely on bank loans to fund inventory and, if they're lucky, to fund growth. But unlike Apple or Microsoft, they don't have billions in cash to weather rising borrowing costs in the form of higher interest rates. Instead, small businesses typically have floating rate debt, and in late 2025, small business loan rates were hitting 11.5%. They are facing a stagflationary crisis. High costs, tightening credit, and they can't afford the fancy AI tools that could actually save them money. So where does this all end? We're reaching a breaking point. The US economy is 70% consumer spending. If the bottom 60% in the lower arm fully runs out of credit and stops spending, the upper arm will also eventually feel the gravity. You can't sell iPhones or AI subscriptions if the customer base is out of money to spend. We are looking at a great bifurcation. It's a tale of two economies living side by side. One is booming, fueled by tech and assets. The other is struggling, weighed down by debt and inflation. Understanding this split is the only way to make sense of the mixed signals we see about the economy every day. For the lucky few, there's a sea of seemingly endless growth and opportunity. For everyone else, the prospect of the American dream seems as far away as it ever has. Again, I'm Jeff Gallick, and thanks for watching. I'll see you in the next one.